So you as an investor inside of your 401k, you can go individually combine these different mutual funds to build a portfolio that's right for you, or you can select a target date fund. And this target date fund will say, if you're gonna retire around this year, here's maybe generally a portfolio mix or mix of different funds that we think is most appropriate for you. Now there are some benefits to this. Number one, you don't really have to think about it. You choose the year that corresponds with your retirement year, and this portfolio is gonna be managed that way. The second benefit is it's professionally managed. You don't have to worry about, is this gonna be way off track, or is this gonna be too speculative or too aggressive or way too conservative? At least within reason, you know that this is going to be a professionally managed fund. And number three, it's going to be more aggressive or more conservative based upon your time horizon of when you're going to retire. So those are the benefits of target date funds. The downsides though are this. Number one, it's cookie cutter. Just because you're gonna retire in 2030 and another individual is gonna retire in 2030 doesn't mean you should have the same exact portfolio. Unless your income sources in retirement and your expenses in retirement and your lifestyle in retirement and your tax situation in retirement and your risk tolerance in retirement, unless all of those things are the exact same, you probably shouldn't have the same exact portfolio. Now with a target date fund though, it's gonna manage fairly generally. You and every other individual in that 2030 fund, you're all gonna have the same portfolio. So it's a cookie cutter approach that might get you close to where you wanna be, but very rarely is it going to be the perfect allocation for where you are, what your goals are, and what your risk tolerance is when looking at retirement. The second downside is, depending on the provider, these funds might actually be fairly expensive. So if you go back to what I said earlier, most mutual funds, if you're owning a large cap growth fund, for example, it's gonna have one internal expense, and then it's gonna go own the different stocks that you want to own in your portfolio, or that it wants to own in that portfolio for you. With a target date fund, depending on the provider, you may have the expense for the fund itself, and then you might have expenses for the mutual funds it is then owning. So because there's two layers of fees there, what you're getting is the target date fund's internal expense, plus you're paying the mutual fund expense for the underlying holdings. Not every provider is like this. Some providers are very good about condensing those expenses or even eliminating the expenses at one of those levels, but some providers, you're double paying because of that. And the third downside, and to me, this is my biggest concern with most target date funds, is they tend to get too conservative too quickly, in my opinion. Let's take a look at an actual example. Now what we're looking at here is, this is an actual example from one of the main providers of target date funds for many retirement plans around the US. What this is looking at is, it's called the glide path. So you see when it says retirement glide path here, what that means is if you choose a target date fund that corresponds with the year that you might retire, you can do that down here. So let's take a look at this. Let's assume that you are in the Retirement 2040 fund. What that means is you are going to be mostly in equities, so mostly in stocks that year, but as you get closer to retirement, that level of stocks is going to fall, and it's going to fall to about 55% by the time that you actually retire. So 55% in stocks, 45% in bonds, and then it's going to continue to fall. At least this provider, it's going to be about 35% to 40% stocks 25 years into retirement. Now, as we look at this, in my opinion, gets far too conservative far too quickly. For one, if we go all the way back to 2065, now that's someone who has a 40+ year time horizon. You can see it's not much, but there is a little bit here that's in bonds. Now, if I have 40 years to go until retirement, I might not want to own any bonds. That might be a drag to my portfolio. Obviously, your personal risk tolerance and other factors come into play here. But to me, this whole section here, all these bonds, whether you're 2060, 2065, 2055, I don't want that personally in my portfolio. And depending on the investor, they might not want it either. That's part of the problem. But the bigger problem, in my opinion, is this inflection point right here. What you can see is, at this point, the level of stock starts dropping pretty dramatically, so that 20 years out, you start decreasing your stock exposure. Once again, I'm James Knoll, founder of Root Financial, and if you're interested in seeing how we help our clients at Root Financial get the most out of life with their money, be sure to visit us at www.rootfinancialpartners.com.